Listen to me very carefully, because I am only going to say this once, and every second you waste not understanding what I'm about to tell you is a second the market is using against you. You are living in the most financially distorted, debt-saturated, geopolitically explosive environment in modern history. $40 trillion in national debt, trade wars ripping apart supply chains that took decades to build, conflicts igniting on multiple continents simultaneously, a Federal Reserve that doesn't know whether to fight inflation or rescue growth, an artificial intelligence bubble that has essentially become the load-bearing wall of the entire S&P 500, and yet, and this is the part that should be keeping you up at night, the market refuses to crash. Not a real crash. Not a 2008-style gut-wrenching, portfolio-destroying, years-long bear market. Just small dips that vanish within 72 hours like they never happened. Most people look at this and feel relieved. I look at this and see a system operating on mechanisms that the vast majority of investors do not understand, cannot see, and are completely unprepared for when those mechanisms finally break. That is what we are going to dissect today, with numbers, with precision, and with zero tolerance for wishful thinking. If you're not already subscribed to this channel, you are making a financial mistake right now. The intelligence I am distributing here for free is the same class of structural market analysis that institutions pay research desks hundreds of thousands of dollars per year to produce. I am giving it to you at no cost because an informed investor is a dangerous investor, and I want more dangerous investors in this world. Hit the subscribe button, turn on notifications. Do it now before you forget, because the next video I release may be the one that saves your portfolio. Now let us talk about the first force holding this market up. And it is the one that has been operating the longest, the one that has trained an entire generation of investors to believe that the Federal Reserve is their personal insurance policy. It is called the Fed put. And if you do not understand exactly how it works and exactly what breaks it, you are navigating one of the most complex financial environments in history with a blindfold on. The concept is straightforward, even if its implications are enormous. The Fed is not a law, not a written policy, not a contractual obligation of any kind. It is a psychological expectation, a deeply embedded market belief, reinforced over 15 consecutive years, that whenever financial conditions deteriorate severely enough, the Federal Reserve will intervene. They will cut interest rates, they will print money, they will purchase assets. They will do whatever it mechanically takes to prevent a sustained collapse. And here is the critical thing you must understand. It does not matter whether this belief is rational or justified. It only matters that enough market participants believe it, because that belief alone changes behavior, and changed behavior changes prices. This expectation was forged in 2008 when the Federal Reserve and the Treasury Department executed the largest financial bailout in American history. They rescued institutions that had taken catastrophically reckless risks, institutions that had built leveraged positions so enormous and so opaque that their failure would have cascaded through the global financial system like a demolition charge through a skyscraper. The Fed stepped in, rates went to zero, and the message delivered to every investor on the planet was unmistakable. We will not let the system collapse. Then in 2020, they did it again, except this time the scale was so far beyond 2008 that it was almost incomprehensible. Trillions of dollars printed rates at zero, direct stimulus payments to households. Every asset class inflated simultaneously. The message was reinforced with a sledgehammer, and here is why they keep doing it, because this is the part most analysts get wrong when they reduce it to bailing out Wall Street. U.S. household wealth, excluding primary residences, is approximately 47% allocated to equities. That is not a Wall Street statistic. That is a Main Street statistic. American households have never in the history of this country been this exposed to the stock market. When the market drops 40%, it is not hedge fund managers who feel it first in their spending behavior. It is the teacher with a 401 kilobits, the nurse with a retirement account, the small business owner with a brokerage account. Consumer spending collapses, the economy contracts, tax revenues fall, the recession deepens, the market falls further. It becomes a self-reinforcing doom loop, and the Fed knows that preventing the first step is far cheaper than trying to arrest the spiral once it has begun. Right now, as I am recording this, the Federal Reserve is engaged in what they are calling reserve management purchases. They are injecting approximately $40 billion per month into the financial system. They are not calling it quantitative easing because quantitative easing carries political and inflationary baggage they would prefer to avoid. They have given it a name so deliberately technical and bureaucratic that the financial media barely covers it and the general public has no idea it is happening. But let me translate it for you in plain language. They are printing money and putting it into the system, and that money finds its way into asset prices. It puts a floor under the market. It is not as aggressive as post-COVID money printing, but it is a continuous, quiet pressure that prevents the kind of sustained downward momentum that produces genuine bear markets. But here is where you must pay absolute attention, because this is the kill switch. The single condition under which the Fed put becomes worthless: inflation. If inflation accelerates, driven by sustained high oil prices, by supply chain disruption, by tariff-induced cost increases, the Federal Reserve loses its ability to act as the market's backstop. You cannot cut interest rates to rescue a falling market when cutting rates would pour gasoline on an inflation fire. The moment the Fed is trapped between a crashing market and accelerating inflation, the put is disabled. That scenario has a name. It is called stagflation, stagnant economic growth combined with high inflation. And it is not a theoretical tail risk right now. It is an actively developing possibility that every serious investor needs to be monitoring with real discipline and real data. Not headlines, not television commentary, but actual inflation metrics and Fed communication parsed with precision. The second force is, in my assessment, the most structurally powerful of the four, precisely because it operates on pure mechanical autopilot, with no human emotion, no discretionary judgment, and no ability to be talked out of buying. I am talking about the passive investing machine, index funds, ETFs, and target date retirement funds, and the relentless, indifferent, automated capital flows they generate every single week. In 2010, passive investment vehicles represented approximately 19% of total equity market assets. Today, that number is 60%. Think carefully about what that shift means. In 15 years, the dominant force in the stock market went from active managers who analyze valuations, earnings, balance sheets, and economic conditions before making buy and sell decisions, to automated systems that do not analyze anything. They simply buy whatever is in the index at whatever price the index is trading on a predetermined schedule regardless of market conditions. Every 2 weeks, tens of millions of American workers receive a paycheck, and a fixed percentage of that paycheck automatically flows into a 401 kilobits or pension account, which automatically deploys that capital into index funds. There is no human in that chain making a decision about whether now is a good time to buy. The buying happens whether the market is at an all-time high, in the middle of a panic sell-off, or anywhere in between. Think of the market as a bathtub. Money flows in through the faucet continuously. That is the passive 401 kilobits autopilot. When a crisis hits and investors get scared, money flows out through the drain. That is active selling, panic liquidation, institutional risk reduction. But here is the mathematical reality that most retail investors never grasp. As long as the faucet runs fast enough, the bathtub never empties. The constant inflow of passive capital cushions every sell-off, because even as sellers are hitting the exit, new money is still arriving at the entrance and buying what those sellers are dumping. This is the mechanical explanation for V-shaped recoveries. This is why every single dip since 2010 has looked, in retrospect, like a buying opportunity. It is not because markets are efficient. It is not because earnings just, it is because an enormous, automated, Emotionless capital allocation machine was buying throughout the entire sell-off and accelerated the rebound. There is, however, a critical vulnerability in this system, and it is tied to a single variable: employment. The passive faucet flows as long as people have jobs. The moment unemployment spikes from 4% to 7 or 8% in a genuine recession, the dynamic inverts catastrophically. Workers do not merely reduce their 401 kilobits contributions. They stop contributing entirely, and a meaningful percentage begin liquidating their retirement accounts to cover immediate expenses: rent, medical bills, groceries. The faucet slows to a trickle and the drain widens simultaneously, and layered on top of that structural vulnerability is the demographic reality of the boomer retirement wave. The largest generation of investors in American history is transitioning from net buyers to net sellers. For decades, boomers were adding capital to this bathtub. Now they're withdrawing it systematically to fund their retirements. That is a persistent growing headwind on the inflow side that will intensify every year for the next decade. The playbook of the last 15 years was written under specific structural conditions. Those conditions are changing. Investors who do not recognize that will be the last to understand why the next drawdown does not recover in 3 days. The third force is one that most retail investors know exists, but fundamentally misunderstand in terms of how it actually functions during periods of market stress. I'm talking about algorithmic trading systems, specifically the class of quantitative funds known as CTAs, or commodity trading advisors, and they now account for a massive proportion of daily market volume. The way these systems work is almost insultingly simple on the surface. When prices trend upward, they buy. When prices trend downward, they sell. There is no fundamental analysis, no earnings assessment, no macroeconomic framework, pure trend following, executed with computational speed and scale that no human trader can match. Now, your immediate instinct might be that this makes crashes worse, and you would be partially correct. When the market begins to sell off, CTAs do indeed add selling pressure, and their selling can amplify the initial decline in ways that feel violent and dislocating to investors who do not understand the mechanism. But here is the critical insight that changes your entire interpretation of how modern markets behave during a crash. The selling exhausts itself. CTAs can only sell positions they already hold. They are not infinitely short. Their selling has a mathematical ceiling determined by the size of their existing long book, and once they have reduced or eliminated those positions, the selling pressure from that source disappears entirely. The market finds a floor, not because the fundamental problems have been resolved, but because one major source of mechanical selling has run out of ammunition. And the moment the algorithms detect stabilization, they flip. The same trend-following logic that drove them to sell now drives them to buy. And they do so aggressively and in coordination, because when one major algorithmic system begins buying, the price movement that creates is itself a trend signal that triggers other algorithmic systems to buy. It is a mechanical snowball, selling exhaustion followed by algorithmic buy signals followed by a rapid, aggressive, automated recovery. This is the machinery behind what looks to the average investor like irrational market resilience. It is not irrational, it is mechanical. And understanding the mechanism is the difference between panicking at the bottom and positioning correctly ahead of the reversal. Woven into this algorithmic picture is a fourth force that has emerged since approximately 2020 and has become genuinely significant in terms of daily market volume. Retail investors. Individual, non-institutional investors now account for roughly 20% of daily equity volume. That is not a trivial number. That is 1/5 of all market activity driven by people who, in aggregate, have internalized a single dominant investment philosophy: buy the dip. The phrase became popular because the strategy worked repeatedly throughout the post-COVID period. Every sell-off rewarded buyers. Every panic proved to be an overreaction. The behavior became conditioned, almost reflexive. But I want you to understand something important here, because complacency built on a strategy that worked for 5 years is, one of the most financially dangerous states a person can occupy. During the Iran-related market stress event, retail conviction failed. Investors who had been reliable, almost mechanical dip buyers did not buy. They sat on their hands, or they sold. The behavior that had been consistent enough to be modeled as a market support mechanism simply did not materialize when the geopolitical fear reached a certain threshold. That is a warning signal. Just because retail bought every dip from 2020 through 2024 does not mean the behavior is a permanent, reliable market feature. It is a conditioned response built on a specific set of outcomes. And conditioned responses break when the outcomes change. Now let us assemble these four forces into a complete architectural picture, because understanding them individually is useful, but understanding how they interact is where the real analytical edge lives. The Fed puts the psychological floor, the belief that catastrophic outcomes will be prevented by institutional intervention. Passive flows provide the mechanical floor, the constant automated inflow of capital that cushions every sell-off regardless of its fundamental cause. Algorithmic systems provide the recovery accelerant, the mechanical exhaustion of sell-in pressure followed by rapid, trend-driven buying that produces V-shaped rebounds. And retail conviction provides supplementary buying pressure that reinforces and extends recoveries. These four forces have operated in concert for 15 years, and together they have produced a market environment where sustained bear markets have become functionally impossible under normal conditions. The critical phrase is normal conditions, because each of these four forces has a specific vulnerability, a precise set of conditions under which it fails. And if those conditions develop simultaneously, the cumulative support structure does not weaken, it collapses. So let us be precise and methodical about what actually breaks this market, because this is not an academic exercise. This is the risk management framework every serious long-term investor needs to have embedded in their thinking right now. The first and most structurally dangerous threat is a bond market revolt. This is not a concept that lends itself to dramatic headlines, but make no mistake, it is the most powerful financial force on the planet. The U.S. government is carrying approximately $40 trillion in debt, and that debt must be continuously refinanced as bonds mature. The bond market sets the interest rate at which that refinancing occurs by determining what yield investors demand to purchase Treasury securities. If bond market investors, and this includes major foreign holders of U.S. Treasuries, begin demanding 5, 6, or 7% yields to compensate for the risk of holding U.S. government debt, the cascading effects are devastating. Money flows out of equities into bonds because a government-guaranteed 5 or 6% return with minimal risk becomes vastly more attractive than equity risk premiums at current valuations. Corporate borrowing costs rise, crushing earnings. Consumer credit tightens. Mortgage rates spike. Economic activity contracts. And the Federal Reserve, facing this constellation of pressures, may be unable to cut rates without further inflaming inflation concerns. This is not a black swan. This is a structurally plausible scenario given the trajectory of U.S. fiscal policy, and it is one you should be monitoring through the 10-year Treasury yield every single week. The second threat is the inflation trap, which is the mechanism by which the Fed put gets disabled. We have already covered the conceptual framework, but let me make the numbers concrete. If oil prices sustain above $125 per barrel, the inflationary transmission into the broader economy is not linear. It is geometric because oil is embedded in virtually every cost structure in the modern economy: agricultural inputs, plastics and packaging, transportation and logistics, pharmaceutical manufacturing. Every price point across the consumption chain absorbs a petroleum cost component. And when that cost rises sharply and stays elevated, headline CPI moves in a direction that makes Federal Reserve rate cuts politically and economically untenable. The Fed cannot lower rates to rescue a falling market. When doing so would push inflation from 5% to 8%. At that point, the market's most powerful psychological backstop is neutralized, and the market must find its own floor based on actual valuations, which, at current price to earnings multiples is significantly lower than where we are trading today. The third scenario is the one I find most intellectually compelling from a historical perspective, because it has played out with remarkable consistency across every major technological innovation cycle in the past century. The top 7 stocks in the S&P 500 currently represent 40% of the entire index's market capitalization. NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta, Tesla. These 7 companies are carrying the valuation of the entire tech market on their collective balance sheets, and the primary justification for their current valuations is the anticipated payoff from artificial intelligence. Here is the pattern I want you to internalize, because it will serve you for the rest of your investment career. Every major technological innovation, railroads, electrification, the automobile, the internet, follows the same investment cycle. Perceived payoff dramatically outpaces actual payoff in the early phase. Investor expectations become untethered from realistic deployment timelines and economic impact. Valuations reach levels that can only be justified by assuming the most optimistic possible outcome materializes on the most optimistic possible timeline. And then reality intrudes. Not because the technology fails. Often it succeeds beyond what anyone initially imagined, but because it takes dramatically longer and costs dramatically more than the market's initial enthusiasm priced in. The gap between perceived payoff and actual payoff produces a violent, sustained correction. The internet was not a failed technology. It transformed the global economy. But anyone who bought the NASDAQ at its 2000 peak waited 15 years to break even. If the AI investment cycle follows the historical pattern, and I have no compelling reason to believe this cycle is categorically different, the correction in the top 7 stocks would mathematically produce an S&P 500 decline of 30 to 40% from peak valuation, even if the other 493 companies in the index are performing adequately. Beyond these 3 primary scenarios, there is the persistent demographic headwind of boomer retirement liquidation, a slow-moving but mathematically certain shift of one of the largest pools of investment capital in history from net inflow to net outflow. And then there is what the market always underweights, because by definition, it is not visible in advance. The true black swan, a sophisticated cyber attack on financial infrastructure, a nuclear miscalculation in a regional conflict that escalates beyond anyone's model, a financial institution whose true leverage and risk exposure is discovered only after it has already detonated. The history of markets is a history of the thing that nobody was specifically worried about being the thing that finally broke the system, not because analysts are incompetent, but because the financial system is complex enough that genuine systemic risk can be hidden effectively until the moment it cannot. Your job is not to predict which black swan lands. Your job is to ensure that when one does, your portfolio does not require a perfect outcome to survive it. Which brings us to the only question that actually matters. How do you position? There are 2 scenarios, and you need to have a specific, executable response to each one rather than a vague intention to be careful. Scenario 1, the system holds. The 4 forces continue to operate. The Fed retains its ability to backstop. The passive flows continue. Algorithms continue generating V-shaped recoveries. In this scenario, you remain substantially invested in equities, but you are not in a passive index position watching 40% of your capital pour into 7 stocks. You are using the tools of active intelligence, money flow analysis, sector rotation signals, relative strength data, to ensure your capital is concentrated in the areas that are actually receiving institutional buying pressure, not just the areas that received it 5 years ago. Scenario 2, stuff breaks. One or more of the kill switches activates. Bond yields spike, inflation disables the Fed. The AI cycle corrects. In this scenario, you need exposure to hard assets, physical gold, silver, commodities that historically appreciated in inflationary, high uncertainty environments. You need defensive equity exposure in sectors that benefit from the very conditions that are hurting the broader market: energy services, commodity producers, infrastructure companies operating in supply-constrained environments. And if you have the sophistication and the discipline, you can purchase options-based portfolio insurance that costs you minimal premium in normal conditions, but provides meaningful downside protection during a genuine dislocation. The people who had oil and gas services exposure in October of the year before the Middle East conflict escalated did not make money because they had superior geopolitical intelligence. They made money because they read money flows correctly. They saw institutional capital rotating into that sector before the catalyst was publicly visible, and they followed the capital. That is a repeatable, learnable, executable skill. It is not luck. It is not a prophecy. It is discipline applied to the right data. Here's what I need you to understand before you close this video and return to whatever comfortable financial illusion you were operating under before you pressed play. The most dangerous financial condition is not a crash. Crashes are violent and obvious, and they trigger defensive instincts. The most dangerous financial condition is a slow, grinding, complacency-driven exposure to a system you believe is permanent because it has persisted for as long as you can. Remember, every financial catastrophe in modern history was preceded by a period in which the majority of market participants were absolutely convinced that current conditions would continue indefinitely. The argument was always different. This time it was housing. Last time it was internet infrastructure. The time before that it was emerging market debt. But the underlying psychology was always identical: the belief that the current regime is not just stable but structurally permanent. It is never permanent. The four forces I have described today are real, they are powerful, and they have produced 15 years of extraordinary resilience. But they each have specific, identifiable kill switches, and those kill switches are more proximate today than they have been at any point in the last 15 years. You now understand the architecture of this market more precisely than 90% of the people investing in it. That understanding is not valuable if you do not act on it. Watch your interest rates, monitor your inflation data, track institutional money flows, position for both outcomes. The investors who will be destroyed in the next major dislocation are not the ignorant ones who never understood the system. They are the informed ones who understood it, saw the warning signals, and chose comfort over action. Do not be that investor. The market does not grade on effort, it grades on outcomes.